Hello and welcome to the first quarterly update of 2026. This is the first of two videos being produced to accompany our quarterly written report. This video is going to look at what's been happening in the global economy and in some of the various different asset classes that we might want to invest in. And then in video 2, we'll look at how portfolios have performed and what's been driving some of those returns. And the first thing to say is actually 2025 was a really good year for lots of the different asset classes, and that means a good year for portfolios overall. So for example, our balanced portfolio went up by just about 9% over the course of the year, which is a pretty good result. And in fact, most asset classes went up last year, whether that be equities, bonds or real assets, and we'll come on to that more in a minute. But I think what's remarkable about 2025 is just how steady those returns have been, at least since roughly the end of April. Markets have generally since then been moving very steadily higher in a very much an orderly fashion. And I say that's remarkable because, of course, politically or perhaps geopolitically, it's actually been quite a turbulent year. So from an economic and market point of view, much of the focus has been on US President Trump and his trade tariffs. And it's worth, of course, reminding ourselves just how turbulent things were back in April when Trump announced most of his tariffs on Liberation Day, and we saw the US market drop about 20% over a short period. But after those falls, Trump had a bit of a rethink. Perhaps he was a little bit spooked by that market reaction, and then he rode back, of course, on a lot of those tariffs, and that allowed markets to recover. And since then, markets have continued to climb pretty steadily. And as we've seen a lot of recently, the US market in particular has been driven by what's been happening in some of those big tech stocks as part of that artificial intelligence trend. So let's have a look at how some of the asset classes have performed over the last year. So this chart is one we call our asset class quilt. It looks at the calendar year returns of the various different asset classes. It looks at most of the major asset classes, and it uses a colour code to explain which did better or worse in that particular year. We think it looks a little bit like a patchwork quilt. And it is a very busy chart, and a lot of that is intentional. Because really what the main reason we like to show this is it just shows how unpredictable markets can be. So an asset that's red one year, which means it's done really poorly, sometimes can be green the next, which means it's done really well, and vice versa. And notably, we can see that in UK real estate. And you see that has been red in 6 of the last 10 years. So it's the worst performer in 6 years of that 10. But it's also been green in 3 years, so been the best performer or one of the best performers in 3 different years. So real estate, we can see, tends to be a bit of a feast or famine. And right now, after such a bad run, we're looking at this and wondering if maybe it could be due one of its good years. On the flip side, I think probably the most consistent asset class over 10 years is the S&P 500 index. You can see that we've seen quite a lot of green all the way across, including both 2023 and 2024 when it was the best of the asset classes on here. Over the last decade, the US has generally done quite a lot better than most of the others, as I've said before, driven by those big tech stocks in particular. But if we look at last year in particular, interestingly, all the other equity regions actually did better in 2025. Notably, we can see the UK, Europe and emerging markets produced over 20% returns, which is more than double the US, which did about 9%. So partly that's because of currency. So the US dollar actually fell quite substantially over the year as investors generally lost a little bit of confidence about what's happening in the US. So that essentially reduced the returns for UK investors. On the other hand, if we look at fixed interest returns, here we can see, well, certainly returns haven't been nearly as spectacular, but they were still solid last year, with gilts returning more than 5% and corporate bonds over 7%. But all in all, a pretty good year for lots of different asset classes. If we're looking forward, the global economy actually seems to be in pretty good shape. Lots of the underlying economic indicators we look at look pretty okay. Certainly company earnings seem to be doing quite well. And therefore, hopefully, things should continue in the manner that we've seen. The problem is, of course, there's geopolitics. There's so much unpredictability out there. We just don't know what Donald Trump might do. We've witnessed, for example, recently we've seen him go into Venezuela. Now that hasn't had an effect on markets, but of course we just don't know whether something that they do might have an effect. So that kind of leads to a little bit more caution than might otherwise be the case when we're just looking at underlying economic data. From an economic point of view, one of the big drivers of what happens will be interest rates. Now, interest rates on both sides of the Atlantic have been cut this year, which is one thing that has helped markets to do well. And markets at the moment expect maybe one, perhaps another two cuts of 0.25% in 2026, again on both sides of the Atlantic. But much here will depend, particularly in the US, on what happens with the Federal Reserve. The chair, Jay Powell, is coming to the end of his term in May, and it's almost certain he is going to be replaced by somebody else. Donald Trump has made it very clear that he will only appoint a new chair who is going to cut interest rates or vote to cut interest rates quite considerably. Now, of course, he's part of a committee, and other members of a committee might have some other views. But essentially, what happens with the Fed and the chair could have a big impact on the US economy. Now, in the US, inflation remains above target, as we can see on this chart, and it's actually been heading in the wrong direction recently, heading back up again, partly due to those trade tariffs. So whilst the Fed might want to cut interest rates, inflation might constrain how much they're able to do that. Meanwhile, here in the UK, again, we've had inflation higher than we'd like to see, but it does now appear to be heading back down. And that should be helped by the changes to energy policy that were announced in the budget. It's estimated by the OBR that these changes could bring down inflation by about 0.5% from around April onwards. So that would be a positive for the UK economy. If we look at markets going forward, we remain pretty positive about the potential returns for fixed interest, where lots of different types of bonds have got a relatively attractive yield in our view, which means hopefully they should continue to produce a reasonable return given their relative to their relatively low level of risk. For equities, we still do remain a little bit wary because some parts of the stock market looks relatively expensive compared to history. So this chart shows how expensive or otherwise each of the main stock markets are. This is based on lots of different valuation metrics, all sort of combined together, and there's over 40 years of data behind it. So we call it the graphic equalizer. Essentially, the black bar for each region shows the current valuation, and the higher the bar is, the more expensive the market relative to its own long-term history. So what this shows is that no region is cheap by historic standards. Only Japan is slightly below its long-term average, but we do need to be a little bit wary with Japan because they had a big bubble in the 1980s, so their average is a little bit higher than some of the others. But even so, we think Japan still looks reasonable value. And you can see the UK and China are also roughly close to their long-term average valuations. But some of the other markets are a lot more expensive, and notably, the US valuation has essentially never been higher in any of those 40 years of data that we're looking at. It's right at the very top of the range. And in the past, where we saw things getting kind of close to those valuations, then we saw the stock market in the US fall over the next sort of 5 or 10 years. So we're not saying we think the US market is going to fall imminently. And of course, we can't say that the same thing is going to happen in the future. Maybe with all those AI stocks and the artificial intelligence sort of increasing the profits and the speed at which those profits are growing, maybe it doesn't matter that the market is as expensive. But we do think, given what we've just said, it just makes sense to be a little bit wary at the moment. We also think it just makes sense to allocate a little bit more to some of the areas which aren't quite so expensive. And in fact, we think we can still get some pretty good exposure to the US market, but without just putting all of our money, if you like, in those big US tech stocks and just following that AI trend. So for example, rather than buy a S&P 500 index tracker, which is market capitalization weighted, essentially what that means is you put the most money in the biggest stocks. So people like Nvidia, Microsoft and Apple, they make up a much bigger proportion of the index than a very smaller company. We could, instead of doing that, we could buy an equal weight version of the S&P 500 index. So essentially buy the same 500 companies, but weight them differently. Put an equal amount in each one rather than the most in the big companies. So you would put the same amount in the 500th biggest company as in the biggest company. So you put a bit more essentially in smaller and medium-sized companies and a bit less in the mega cap tech stocks. This chart shows you why you might want to do that, because the equal weight version of the index is nowhere near as expensive as the sort of normal version of the index we look at, which has got all that big tech exposure. So the blue line shows the forward price earnings ratio of the equal weight index, while the black line shows the standard index. And essentially the higher the ratio, so the higher the line is on the chart, the more expensive the market is, and then that tends to have coincided with lower returns in the future. So if you look at for most of history, the two lines are basically the same. The blue and the black line just follow each other. But since the launch of ChatGPT and the beginning of that AI craze, the black line, which has more exposure to the big tech stocks, has gone up a lot, while the blue line hasn't. So the big tech stocks have gained, they've become more expensive, and that means, again, they look relatively expensive compared to history, but the rest of the market is relatively normal levels, kind of in line with long-term averages. So we prefer at the moment to put a bit more money in the cheaper parts of the US market and a bit less in the more expensive areas. So we hold the equal weight index and less in the market cap weighted index, and we've allocated a bit more to different regions and a bit less to the US as a whole. So in summary, we just think we just need to be a little bit cautious at the moment. Not to say we don't expect some reasonable returns from portfolios and from markets going forward, but just in order to get those returns, we should maybe allocate a bit less to the US big tech stocks and a bit more to other regions that look better value and other asset classes like bonds that we also think look better value. And in the next video, we'll look at how portfolios have performed and how all of that has affected those returns.